Hello there. So we are continuing with our series to learn fundamentals of accounting 1. I believe you have seen the previous video on the overview of the course, or rather the unit. So today we will be talking about journals. Okay, so I will explain briefly on what a journal is, and then once I have explained what journal, or rather journaling is, we will do a simple example using these transactions that are displayed. Okay, so maybe you can pause the video and write the transactions, or rather the question, so that once we start, you will be taking down the notes. Okay, so let me first of all talk about just briefly what journaling is. So journal is just recording transactions. Okay, it's all about transactions. So now, the moment you are talking about transactions, we are saying one concept which is very clear, maybe in our classes, that all transactions should be in line with the double entry rule. Okay, double entry rule. So what do we mean by double entry rule? We simply mean that for every debit, which in short form is written like that, for every double entry, there is always a translating credit entry. Okay, so in each and every transaction, there should be a debit and a credit. Okay, and so let me just write a plus sign. Now this is the format which we will use in each and every transaction. For every debit, there must be a credit. Okay, so that is the part of the transactions. So in each and every transaction, there must be an item which is under the revenue category, expense category, asset category, liability category, and capital. This one I talked about it in our last video, and I used the mnemonic recall: R for revenue, E for expense, C for capital, A for asset, L for liabilities. And what I said was that in this family, okay, this family consisting of revenue, capital, and liability, whenever they increase, okay, when there is a positive change in revenue, capital, or liability, what will we do? Exactly, we will credit. When there is a negative change in revenue, capital, or liability, we debit. And then this family down here, consisting of expense and asset, it is the vice versa of the other family, whereby when there is a positive change, or rather when there is an increase in expense or asset, you will debit. And when there is a negative change, or rather a decrease, you will credit. So with this, it will help you to do any journal entry. So skipping all the theory part, now let us come and tackle this example. So here we have a business which is starting. It is a real estate agency. So these are the transactions. So if we look at January 1st, invested 400,000 Kenya shillings cash in his real estate agency. So here the business is starting. Okay, what did I say? I said that in every transaction. So here our January 1st transactions, in the first day January, the transaction itself, we are being told already invested 400,000. That transaction has two accounts, and one of them we will debit and one of them we will credit. So let us ask ourselves, the moment a business is starting, that 400,000 is in cash form. So meaning there is one account, cash. Okay, so we will have a debit and we'll have a credit. So already we've seen that in that transaction there is cash, and this is cash which is being put into the business. So here we are looking at transaction on the basis of a business. So let us say now we are the real estate agency. So we were not there, but now Mr. Martin created us and he has invested money in us. So it means that we have a cash. We have cash worth 400,000. Now cash is under assets. Okay, and in this family asset, we didn't have cash, but because of Mr. Martin, now we have. So that is a positive change. So what does it mean? We will debit the cash. Okay, we will debit cash account. So what will we credit? We all know that the cash which is invested at the start of the business is normally called capital. Okay, now we look at the family which capital is, and we see that when capital has a positive change, we credit. So we credit capital. So we debit cash and we credit capital with that amount, 400,000. Okay, 400,000. Simple as that. So now let us work together in all these other transactions. January 2nd, paid 3 months rent in advance, 24,000. So here there's a payment which is being made, and since you have been given the amount, now that amount is in cash. Okay, why? Because the business has money in cash form and we make payments via cash. So let us just start with what we know. We are making payment with our cash. What does it mean? It means that the cash which we had is decreasing, and cash is an asset. So the moment an asset is decreasing, what do? We credit. So let us credit cash. Now in this transaction, that money was being used to pay 3 months rent in advance. So the account which we will create is rent in advance. So someone might ask, why am I just writing rent in advance on debit? This is because the moment you pay any expense, rent is an expense, okay? But this is a payment which is being made in advance. So the moment an expense is paid in advance, it is normally considered as an item in accounts receivable. Okay, I will explain further what accounts receivable is. But under the statement of financial position, which is the last statement which we will do in this series, we will see that accounts receivable is an asset. So since we didn't pay rent in advance, but now we have paid, it is a positive change. It is an asset and there is a positive change. That's why we have debited. Okay? Any questions, kindly just comment and I will see it and I will reply. So moving forward, January 3rd, purchased office equipment and paid 30,000 cash. So we have two accounts. We have office equipment and we also have cash. So office equipment was acquired. So office equipment is an asset and also cash is an asset. But now one is increasing, the other one is decreasing. So a question, which asset is increasing? Yeah, office what? Office equipment. And what is reducing? Cash. Exactly. So these amounts which have been given, for instance, January 2nd, it is 24,000. Just forgot to write them. So this one is 24,000 and this one is 30,000. So we move to the other transaction, January 5th. Of course, there will be a debit and a credit. January 5th, purchased office supplies on credit, Kenya shillings 5,000. So the moment you do something on credit, you involve people who are normally called creditors. Okay? So the person who sold these office supplies to us is our creditor. And the other name for a creditor, okay? The other name of a creditor is accounts payable. I repeat, another name for creditors is accounts payable in accounting. And creditors, these are people who give us maybe assets or other, something, but on credit. We are benefiting from someone giving us things for free, but we will pay them later. So that is why we are calling them accounts payable. Why? Because these are accounts which we will pay them back. And if we have creditors, I know that we will also have debtors. And the other name for debtors is accounts receivable. So who are debtors? Debtors are those parties whom we will serve them for free, but they will pay us later on. Is it really free? Not really. But they won't pay us now, but they will pay us later. And in accounting, we consider accounts receivable as assets. Why? Because these are accounts which later on we will receive a certain amount. So that is why it is classified as an asset. Do you remember here when I said rent in advance is considered as a account receivable? Yeah, so accounts receivable, those are assets, and that is why we debited. So the vice versa is true. The opposite of assets is, liabilities. So liability is an obligation. So accounts payable, this is an obligation that we need to pay these people, creditors. So this one is a liability. So with all that, in this transaction, January 5th, purchased office supplies on credit. So already we know that we have office supplies as one of the accounts, and we also have accounts payable. So in the beginning, we didn't have any debt. We didn't have any obligation, but now we have. So we come to our mnemonic, liability. When liability increases, what do? We credit. So let us credit accounts payable. The moment you write creditors, it is still okay. Creditors is the same as accounts payable. And then the office supplies. Now for the office supplies, that one is an asset. So by default, an asset, when it increases, we debit. Office supplies. And that transaction was worth 5,000. I think now we are getting a hang out of it, and I hope as we finish you will understand fully. So January 9, sold a house and collected 66,000 cash commission on the sale. So here, if you look at the description of the business, it is real estate agent. The moment you're an agent, you are just selling something on behalf of someone, but now for you are being compensated commission. Okay, so part of the revenue of this business is commission. So here we recognize that in this transaction there's an increase in cash because we are paid. All right, we are paid 66,000 in cash. So already we know that cash is an asset, and the moment cash increases, we debit. Okay, now what do we credit? I've just said that the 66,000 is revenue to the business, and if you look at our mnemonic, R represents revenue, and in this family a positive increase will result to a credit. So we credit revenue. Revenue is the same as income. So I hope that one is clear. So we move to the next transaction. January 14th, paid 3,000 for the office supplies purchased on January 5th. 14. So if you look at January 5th, we bought office supplies, but we bought them on credit. Okay, but now on date 14, we are paying 3,000. So it's like we are paying off a little bit of our debt. So we had 5,000 debt. Now we are reducing that debt by 3,000. When we are reducing our debt, we know that the debt is a liability. Okay, that one we know. So if we are decreasing our liability, it means that we are debiting. So let us debit accounts payable. Okay. And as we pay our obligation, we are paying using cash. And we know cash is an asset. When an asset decreases, we credit. So allow me to go a little bit faster. January 16, completed a real estate appraisal on credit and billed the client 25,000 for the appraisal. So this one, the appraisal is another revenue. It is another revenue channel for the business. But here, the client didn't pay. Rather, we served the client on credit, meaning the client will pay us later. Now that is where we have introduced the aspect of accounts receivable. This client is our debtor. Okay, so how do we write it? January 16. So we didn't have a debtor, or rather accounts receivable, but now we have. And we said earlier that accounts receivable is part of an asset. Okay, so when an asset increases, we debit. So we debit accounts receivable. And what do we credit? I've said that this appraisal of 25,000 is a revenue channel. So we credit revenue. Okay? Yeah, I will input these figures later on. So the other transaction is January 23rd, whereby Mr. Martin withdrew 10,000 from the business to pay personal expenses. So anytime that you will see a transaction which involves personal expenses, just know that we are introducing an account called drawings. Drawings is an account which affects directly the capital account. It affects the capital account in the opposite way. So normally, when capital increases, we credit, but drawings affects capital the other way, meaning when drawings will increase, it won't be credit, it will be the other way around. It will be debit. So drawings is an account which we create when we see that the owner of the business is withdrawing something from the business for personal use. And in this instance, Mr. Martin is withdrawing cash worth 10,000. So cash is reducing. And if it is reducing, we do what? We credit. Hope that one is clear. We are remaining with two transactions. So January 30th, we receive 15,000 part payment from the client of January 16. That one is January 30th. So let me just write it here. Here. So in January 30th, that client from January 16, that client is our debtor. Okay? And that client being our debtor, that client is reducing his or her obligation to our business, meaning our accounts receivable is reducing. And since our accounts receivable being an asset is reducing, we will credit that account. So we will credit accounts receivable. So now, what are we debiting? The client is paying 15,000 in cash. So cash is an asset, so we are gaining money. So we debit. Okay. And then the last transaction, January 31st, we are seeing that paid the secretary's salary, 20,000. Secretary's salary is an expense to the company. An expense is something that you've used services from and you are paying. The secretary, we've benefited from the secretary services, and now we are paying the secretary in form of a salary. And we know that an expense, when it increases, because it is a positive change, we debit. So we debit secretary salary and we credit. Or do we credit? Yeah, credit cash. We are paying the secretary in cash. Yeah. So this is how we interpret the transactions from words to accounting. Can I call them accounting words? Yeah. Okay. So now this is a rough format on how you write a journal. But now a professional way for writing a journal is a table format. And that table format is this one. I wrote it earlier. I think it is visible like that. So you can also pause the video and just see how it looks like. Now let me just input. If you look at the structure itself, it starts with the name of the owner. If you have the name of the business, you write it. Then down you'll write journal entries for the month. It can be for the period, maybe an year or a month. So for in this case, it is journal entries for the month of January 2026. Then it has 4 columns. Maybe some of you have been taught to include the column for folio. So if you have been told to include it, then please follow your instructor. But since in the question there is no part whereby folio is being mentioned, we don't include it. Okay? Yeah. So if you look at the transaction in 1st January 2026 in our rough format, we see that we are debiting cash and we are crediting capital with the amount 400,000. So if you look at how I've written the debit and the credit, the debit is just near this line, but the credit account, I have indented it. Okay, that is how you write a journal entry. The debit one, you write it the first one, okay, and the credit, you write it the second one and you indent. Okay, so now allow me to write the values. So for the cash, 400,000. Oh, of course, debit and credit, and you include the currency. So for the debit is 400,000, for the credit is 400,000, a total of 400,000. Yeah, and please don't do this in the exam room. Please use a ruler. So another thing that I would like to say is that in this space, we normally include something which we call narration. Narration is you narrate what this means. And the narration, you just take it from the question itself. For instance, the question says invested 400,000 cash in his real estate agency. So a narration, for me, I normally start my narration by saying to record. So each and every narration, to make it easier for you, you can start by saying to record. So you can say to record cash used to start the real estate agency. As simple as that. You don't have to think of it much. You just write, you just narrate. Okay. Then in rent in advance, the amount was 24,000, right? Yeah, 24,000. And as well as cash, 24,000. And then the total is 24,000, 24,000. So please take note, in each and every transaction, the debit value should always equal to the credit value. Okay, that is the double entry rule. Yeah. So in 3rd January, the amount was 30,000. So this one is like an equal sign. Okay. Yeah. So for 5th January, 5,000. The amount is 5,000. Awesome. 9th January, the amount is 66,000. Okay. 14 January, 3,000. Okay. Now let me just write for the 16th January, and then I will allow you all to do for 23rd, 30th, and 31st. Okay. So for 16th, yeah, it's 16th January. The debit is accounts receivable and revenue. So we write accounts receivable, and then we indent revenue, which is in the credit. And then what was the amount? January 16, 25,000. Okay, so basically that's how you create a journal entry. Okay, so let me not just leave you hanging in the aspect of the narrations. So in 2nd January, paid 3 months rent in advance. So here you can say to record rent payment in advance in cash, just like that. Here you can say to record purchase of office equipment using cash. Here, to record purchase of office supplies on credit. What about here? To record cash received through commission. Okay, you're seeing how easy it is to record. Now here, 14th January, paid 3,000 of office supplies. So that one is to record payment of office supplies bought on credit. Okay, what about this one? To record. Okay, let us compare. To record. Okay, let us say to record. What can we write? Let me leave it this one at the comment section. Kindly write it in the comment section so that I see if this video has been of help to you. So this is how we write a journal, or rather we draw a journal, and I hope this video has been useful to you. So see you in the next one. Please don't forget to share this video with your fellow peers. Like and subscribe to this platform, Academic Booster, for more videos like this. See you in the next one.